Although I talk about many different stocks on this channel with the whole purpose to bring you guys new stocks or stocks that maybe you haven't researched before so that you can then take them stocks, go away, do your own research and make up your own mind. But even though I do that, I myself have quite a heavily concentrated portfolio with just 2 positions accounting for the majority of my portfolio. So in this video, I want to share what my portfolio looks like and what 2 stocks are actually accounted for the majority of it. And I want to talk about why I've actually decided to take a way more concentrated investing approach rather than the largely advertised, the largely advised diversification approach. If you haven't already, give this video a like, subscribe to the channel and press that little notification bell so you never miss an upload. And let's get into it. So when you start getting into investing, one of the main concepts that you'll probably come up against straight away is this idea of diversification. And even if you're an investor that has been around for quite a while, you will also see that, it is advertised that you should be diversified. Diversification, of course, in investing takes many forms. It means perhaps that you have many different stocks within your portfolio. You have many different stocks from economies around the world. You have many different positions that actually give you exposure to lots of different sectors, to lots of different industries. Maybe it goes one step further and actually you have a diversified portfolio in terms of what you actually invest into. You invest into equity, plus real estate, plus bonds, plus commodities, plus crypto. That could be quite a diversified portfolio. But what we see in the mainstream is that a diversified investing strategy is the norm, is the accepted, is the advised, and it is best, I think, for most people. Now, I started following this as well. When I first got into investing, I absolutely thought that I must be diversified. If I am not diversified, I am gambling. If I'm not diversified, I am going to lose all my money. These are the sort of things that I was hearing when I was doing my initial research. But the more and more I've learned and the deeper I've got into this world of investing, something's actually shifted. The less diversified I've become. So I actually started off by investing into a few different funds. I invested, casting my mind back now, I believe the first thing that I ever bought was a Vanguard index fund. And it was one tracking the FTSE 100, which is the largest 100 or so companies here in the UK. Shortly after that, I dabbled in VUSA, which is an S&P 500 ETF. And then I've, dabbled in a few different ETFs and index funds here and there whilst I was on my Vanguard platform. That's how it started. Roll forward to today, and it's been about 4 or so years since I took my first investing position. Like I said, I now have such a different portfolio. I receive a lot of comments saying that I should be diversified and I'm taking on a lot of risk by only having a lot of my money in just a small amount of positions. However, I actually view it very differently to that. I view it as I would be taking on way more risk, and it just doesn't make sense to me to actually be spreading my money across many different positions when actually I've done my research and I've landed on this approach being best for me right now. So that's important, best for me right now. The way I view diversification is I see it going hand in hand with where you are in your investing journey. And where you are in your investing journey can be defined, in my opinion, by many different things. For example, what are you trying to achieve? What are your goals? Are you in a stage of wealth generation or wealth preservation? I think that's a distinction that needs to be made. For me, I am in the wealth generation stage. I am trying to accumulate as much in my portfolio as I possibly can. And then at some point when I come to near retirement or be in retirement, I will go into wealth preservation, whereby the capital that I have allocated in my portfolio is the capital that I now need to start holding on to more tightly and not taking on so much risk, because ultimately that will be funding my lifestyle. But I'm not there yet. So my strategy right now is to make as much money from the stock market as I possibly can. Another way that you can define where you are in your investing journey is, what level of risk are you comfortable taking? Are you someone that has a high risk tolerance? And also, are you someone that has a high risk capacity? Because these two things are very different. Do you have dependents? Do you have a steady income? Are you a high earner? There's all these different things that have to be thought about. Now, I do respect the idea of diversification. And like I said, I do think that it is the best strategy for the majority of people. So the people who should, in my opinion, this is just my opinion, be following a diversified approach are those people who want a hands-off approach. If you have no interest in doing research into particular stocks, you do not care to monitor your portfolio, and that's fine, right? You don't have to care about this world of investing, but you still see a place for investing. You understand that investing into the stock market can be a very, very worthwhile thing that you should be doing to generate more money rather than maybe leaving it sat in a bank account or something like that. But you just don't want to do that extra research. Then just buy in a global, a well-diversified index fund or ETF and just calling it a day and checking your account in 20 years makes the most sense. But what happened to me is that I started investing as a way just to make more money on my money. The normal reasons, right? I had influence from my granddad and all these things. And as I started investing, I'm just someone that is very curious. I like learning. And that led me down a rabbit hole of learning everything that I can about investing. And naturally, this moved from learning about index funds and ETFs. And I documented this on my main channel, and you can see the way that my content has shifted is aligned with this. It went from doing that to then learning about particular companies and what those companies were doing. And that meant that then I became more interested in particular companies, and I was almost selecting stocks because I was doing so much research. And at some point along the way, I just came to the conclusion that it doesn't make sense for me to buy an index fund or a few index funds when actually I have way more interest, way more research, way more conviction in just some companies. However, I do still have an index fund, and we'll talk an ETF, I should say. We'll talk about what my portfolio looks like in just a minute. But I think there's a balance to be found, because someone can have diversification in their portfolio and it can be absolutely fine. But someone else could actually end up being almost too diversified, and they have so many ETFs and so many index funds, and they're actually getting a lot of crossover and a lot of duplication, and that doesn't really make sense at that point. Or an investor could decide, I want to select individual stocks, but I want to be diversified, so I'll just select 40 of them. At that point, in my opinion, I think you're just better off buying an index fund or an ETF, because you must absolutely be doing so much research to select those stocks in the first place. And then on top of that, you have to keep up with those companies. You have to know what their earnings are. You have to know what the fundamentals, what they're working on, new partnerships, new deals that they've got, new products that they're releasing. Because all that information ultimately will help you build your thesis and build your conviction into a company. And if that changes at any point, you might want to sell. Now, if someone is a full-time investor and they're doing nothing else, I think you can potentially stay up to date with maybe a 20 stock portfolio, a 30 maybe even. But that's if you're full-time doing that. If you're an average person that has a day job, has a family, has some hobbies, you also like investing, but you are selecting 40 different stocks, that to me doesn't make sense. That to me is a little bit risky. You might as well just buy an ETF. That's my opinion. Another reason why you must stay up to date and actually research your companies is because it's this that allows you to keep your emotions in check. It's this understanding and this research that allows you not to experience FOMO, to not worry about the stock dropping in the short term, and to actually have such strong conviction that you carry on buying when that position is falling. And a lot of people think that, oh, but the best investors in the world are diversified. Warren Buffett has quite a diversified portfolio. This person does, this person does. Now, two things are to be said here. Firstly, they might have a lot of positions in their portfolio, but they might have the majority of the money in just a few, maybe 8, maybe 6, maybe 5. So have a look at that. And also, a lot of people look at what the likes of Warren Buffett is doing now, today, and they try and emulate, they try and duplicate what he's doing today. But you've got to remember, he hasn't always been getting billions in dividends every year. He hasn't always had this massive portfolio that he has now amassed. It hasn't worked like that. He has spent many, many years building to this point today. And there was a period of time where he was way more concentrated. He had to select a few amount of companies to build his wealth, to be on that wealth generation journey. And then as he's got more money, and he's actually managing money on behalf of other people, he then can spread the risk more, diversify. It makes sense. If you are someone that is struggling with researching stocks and you actually do want to start selecting your own stocks and doing further research and doing your own due diligence, but you just don't have a framework in place, you don't really understand how to read a balance sheet, you don't really understand what you should actually be looking for, don't worry guys, I've got you covered. I made a really in-depth 4-hour video workshop going through every single thing that I do when I'm researching a stock, when I'm putting my money into a stock, because ultimately I am buying a part of that business. If you want to get your hands on that, I will leave a link in the description below. I also saw this post on X from a guy named Jason DeBolt, who is all in on Tesla and has been for a long time. And he actually retired early from Tesla stock. And he has said this: you're much less likely to get FOMO, fear of missing out, when another stock that you don't own starts rallying if you have a deep understanding of your investments. I remember holding Tesla stock between 2013 and 2019 and seeing countless stocks rally whilst Tesla went nowhere. The only FOMO I ever experienced was not owning enough Tesla stock. If your investment analysis begins or ends with stock prices, you're missing out on 99% of the information that drives the stock price in the long term. When you stop thinking of businesses as stocks and start seeing them as unrealized opportunities with an associated probability for each opportunity, you become much more focused and determined to hold. Stock prices are merely scalar quantities, but real investing is much more like advanced matrix multiplication or building a custom neural network in your mind that you can then use to make better long-term predictions. Instead of predicting the next token, you predict the next decade. He sums it up really well there. Again, why you must absolutely be fully researched and do your due diligence if you are going to approach investing more concentrated rather than more diversified. So now with all that said, let's move on to what I have in my portfolio. So here is my main portfolio as of today, and what you can see is that I currently have 9 positions. However, 2 of these are accounting for the majority as a percentage of my portfolio. Right now you can see that I have just over 40% of my portfolio in Tesla stock and nearly 36% of my portfolio in Palantir stock. Now, obviously, this changes on the day-to-day. I have put way more money into Tesla than I have Palantir. However, they are pretty equal as a percentage of the portfolio right now. Why is that? Well, it just depends how the stock is doing, and that will then take up more of the portfolio if one is doing particularly well. I then have about 7.5% Nvidia, 7% Amazon, 3.7% Alphabet, and then a few smaller positions here as well. 2 of these are UK stocks that you might not have heard of: Intelia Therapeutics and Clean Spark. I have spoken about Clean Spark on my main channel. This is not a long-term hold for me, so this won't probably be here in a few years' time. Now, alongside these 9 positions, I also have an ETF, like I hinted at. It's VUSA, which is an S&P 500 ETF that I hold on a different account. And then alongside that, I have a crypto portfolio as well. At this current time, I don't have a real estate portfolio. I would like to have one day. But I'm kind of diversified in terms of I have different investment types, but I'm also, a lot of my money is in just a few things. Therefore, I'm probably not as diversified as the media would say I should be. Now, when I ask myself, why do I have my portfolio set up like this? Why am I willing to put most of my money into just 2 positions, them being Tesla and Palantir? There's quite a simple answer. And that is because when I'm thinking long term, when I think in 5, 10, 15, 20, 25 years time, I have a long term mindset. Where is my money best spent? Where should I put my money for the best returns? And if I'm not going to just buy an ETF, then I absolutely need to be really, really diligent on the answer to this question. And my answer is Tesla and Palantir. With my research that I've done into those 2 companies, and that is many, many hours of research, and that will continue to be ongoing research as well, I don't see a better place for my money at this time. There are other stocks I'm interested in. There are other stocks on my watch list. Nvidia, for example, I have that. It's just in a smaller position that I started building back in December. Fantastic company. Lots of growth still left there in my opinion. But I still have to ask myself every single time I come to invest, where is my money best spent? And those are the 2 companies that I feel most confident and most comfortable putting my money into right now. Doesn't mean that can't change. Something may happen to one of those companies that changes my fundamental thesis, and therefore maybe I take some money out, I take some profit off. Who knows? Who knows what's going to happen? I have a very open mind when it comes to investing. However, they're the companies that I see aligned for the biggest amount of growth in the long term. And ultimately, that's what I care about. Where am I going to get the best growth? Because I am investing for financial freedom. I'm investing to make my future, financially speaking, way better off than it is today. I am not going to follow an approach that I don't think is going to get me to that place. So my plan for the future, well, I'm going to carry on at this stage buying Tesla and Palantir. I am also going to carry on reinvesting the dividends that I get from my S&P 500 ETF to buy more S&P 500 ETF, VUSA is called. So that will keep growing, but it will be growing quite slowly. Tesla and Palantir will probably keep growing at this stage as well. And I might, top up some of my other positions in my portfolio. I think Amazon's a fantastic company as well, and I do put money into that sometimes, and some of the other positions too. I did also make a video talking about diversification in a bit more detail on my main channel, and I'll leave that linked on the screen now, somewhere here or here, if you do want to hear more about this. But I invite you to leave your thoughts and your feelings on diversification versus concentration in the comments below. With that said, thank you so much for watching. Until next time, keep analysing, keep investing, and don't forget to hit that subscribe button.